We go to chapter 8 in accounting AS, control accounts. When we're talking about control accounts, we're talking about an account that is open to check individual trade receivables accounts and individual trade payables accounts. So when we talk about trade receivables account, we're talking about accounts of credit customers. And when we talk about trade payables account, we're talking about account of credit suppliers. So most of the time we use our ledgers, but if we really want to understand the figures, if they are accurate with trade receivable, at the end of your trade receivable ledger account, whatever you get in your trade receivable control account should be the same balance in your trade receivable ledger. That is the point. So you want to check accuracy, that's why you're using it. And mostly businesses, the most transactions they have is either to the customers or to the suppliers. Okay. That's why we have these accounts. So as soon as you are able to validate both trade receivable account and trade payables account, the other items that are left are little. So it will allow you to find errors if there are any. Okay. So note, the closing balance of the control account must equal to the individual trade receivable or trade payables account. I told you about that already. Yes or no?
What?
The individual trade receivable account must equal to the total control account, the closing balance. So what are the advantages of having a control account? The first one, accuracy. It can help to eliminate errors posted in the individual accounts. So because you have the individual ledger account, the individual sales ledger account, the individual trade payables account, you have put them together. So the balance in your trade control account, sales control account must equal to the balance in the trade receivable ledger account. So if they are not equal, it means you need to find the difference. And as soon as you minus the difference between them, you might be able to understand where the error is coming from. This is what I'm saying. You have your trade receivable individual accounts, trade payables individual accounts for each customers or for each suppliers. But in your control account, you're going to have the total figure of sales or the total figure of purchases. So when you find the difference between them, you'll be able to know which account has not been recorded in your ledger. Because sometimes your ledger, you might be missing out in an invoice. But when you're preparing your control account, because most of the time, control account is prepared by someone else, not the same person that prepared the ledger account. So that might allow you to know the difference. Do you get the point I'm making here? So the first advantage is accuracy. It can help to eliminate errors posted in the individual accounts. 2, improve the speed of decision making. I wrote, it helps accountants to provide details about both trade receivable and trade payables, which immediately will allow managers to make quicker decisions. Because now we have the final figure for trade receivables, the final figure for trade payables. Then we would know if we have enough capital, enough cash to pay our trade payables, and if we have to retrieve our cash from trade receivables, we make decisions immediately. Okay. The third point, internal control. It can be used to prevent fraud, as control accounts are prepared by different employees. So if one of the accountants is planning to perpetrate fraud, because the control account will check.
It has accuracy. What is it called? What is
internal control? No, accuracy is different. We're talking about auditing.
Oh, auditing. Okay.
So we want to check because it's a control account. Sometimes the employee would have prepared the account so that he or she can perpetrate fraud. But with someone else checking, the auditors checking through the control account, the auditor might be able to find out if someone that prepares the ledger is trying to make a fraudulent act or not.
Okay.
So it can be a sort of check and balance.
Okay.
So making the process of finding becomes easier. That's the last one there. Making the process of finding errors easier by drawing attention to the ledger which error occurs. So the last thing here is that because it's a control account, it allows you to understand where the problem is coming from.
Okay.
I think it's clear, right?
Yeah.
So go to the limitations now. The first limitation is that not all errors can be detected. What does that simply imply? You can still make errors because in the course of posting in your ledger account, you might understand that the errors are not from the ledger account. Well, the control account does not state where errors are coming from if it is not in the control account. So that means it is limited to sales and purchases. Okay. It can only detect errors from sales and purchases, which means errors from the invoice. That is the only thing it can detect. If there are other errors, it cannot detect it. Okay. Do you understand? The control account may contain errors as this may be as a result of lack of quality of those preparing it. So the other problem is that control account, because it's being prepared by someone, the person preparing it might not have the expertise or skills needed to prepare it. That might make an error. So if you don't have knowledge about preparing the control account, then you might be making a mistake.
Okay.
So that means the problem the control account is about to solve won't be solved.
Okay.
Do you get it or not?
Yeah.
Cost. Control account can be seen as time consuming. Control account can be seen as time consuming, which means additional expenses as there are no new entries. You are not preparing new account. It's the same account that you have previously prepared. You are just putting them in the sales ledger and purchases ledger.
Okay.
So that means you're wasting time, and you might have to pay someone to do that. Do you understand? Any question about that? So go to transfer of transactions to the control account. I wrote, all entries in the subsidiary books of accounts are transferred into the sales ledger, control, trade receivable, or control account of purchases ledger. So that is what the transfer is about. All the transactions in the sales ledger, in the sales day book, will be transferred to the sales control account. And for purchases, will be transferred to the purchases control account. So that takes us to,
Trade receivables control account.
yes, all these ones I'll explain it in the question. So we have trade receivable control account itself. For trade receivable account, this account is used to control credit customers. All entries must be on the same side as the ledger account. So trade receivable ledger account, it must be the same as your sales control account.
I thought trade receivables was on the debit side.
Sales, you sold.
Trade receivables.
Yeah, you sold on credit. You credit the receiver. You debit the receiver, you credit the giver. You sold.
So it's going to be this. Okay.
It will be on the credit side. What you receive will be on the debit side. That's why your bank transactions or whatever transactions you get will be on the debit or on the credit side.
So, okay.
Do you get it?
Yeah.
Your sales, your total sales, the total sales you make will be on the debit side. But all the transactions that bring about that sales will be on the credit side.
Okay.
Do you understand that?
Yeah.
Good. So we have the transactions. So we have opening balance. For opening balance, it could be debit or credit. Anyway, for opening balance, it could be debit entry, it could be credit entry. What makes it to be on the debit entry? If your closing balance, if the difference between the debit side and the credit side ends on the credit side, it will be a debit balance. Do you understand? And if the difference between the debit side and the credit side ends in the debit side, the balance brought down will be on the credit side.
Okay.
I think it's clear. So that means if it's on the credit side, if at the end of the month your transaction the difference between them is on the credit side, it's good for the business. But if it's on the debit side, it means you are owing customers certain amount of money.
Oh.
Clear. So we have that's about the opening balance. It doesn't have any source document. It's about the transactions in the past. Then we have our credit sales. Our credit sales is a debit bundle. It's a debit entry.
Okay.
Our debit sales, our credit sales. You sold to customers. It's a debit entry. And the book of prime entry is the revenue journal or revenue day book. And your source document is invoice, because an invoice represents
Result.
product sold on credit.
Okay.
Then we have receipts from trade receivables.
Okay.
That means payment from trade receivables.
So paid got in.
So the trade receivable account, the individual sales account will have a credit entry, yes or no? Then, because you have received it, right? That means the trade creditor has made the payment. Because the trade creditor has made the payment, it will go to the cash book.
The cash book. Okay.
And the document will be receipts.
Okay.
Do you get it? Discount allowed. Discount allowed is given to credit customers for prompt payment.
Okay.
So it will be part of your cash book. It will be a credit entry.
Okay.
So in your cash book, the debit side of your cash book has bank, discount received.
Yeah.
And on the credit side, you have cash, bank, discount allowed.
Yeah. So.
Clear.
So on your balance, on your debit side, you have revenue day book. On your credit side, you have discounts allowed, returns, invoice day book, and recoverable debts.
And dishonored check. Check of customers that is being dishonored. A dishonored check is a check that is rejected from the bank.
So you basically get this information put in the debit or credit side of trade payables.
Yes, trade receivable or trade payables. So we have receipts. We have discount allowed, which is also going to be on the credit side. We have dishonored check, which is going to be on the debit side. Irrecoverable debt on the credit side. So all the transactions that were done will be on the credit side.
Mm-hmm.
I think it's clear. So we have the format for trade receivables control account. For the format, we have our balance, opening our balance. Most of the time, in your balance, you're going to have opening balance. If it is debit or credit, it will be stated if it is debit or credit. So if it is stated debit, you put it on the debit side. Then your sales, your credit sales will be on the debit side. Then the dishonored check will also be on the debit side. On the credit side are all the transactions that involve creditors, your credit customers. The payment made by the credit customer, discount allowed to the credit customer, return inward by the credit customer, that means sales returns. The irrecoverable debts is from the credit customer also, they are all going to be on the credit side.
Okay.
Clear? Is it clear, please?
Yeah.
So we go to trade payables account. For trade payables account, we're talking about account that checks the accuracy of individual credit suppliers. Trade payable account is an account that checks the accuracy of individual credit suppliers.
Okay, so trade receivables is credit suppliers.
Trade receivable is credit customers.
Credit customers, and trade payables is credit suppliers.
Is it clear?
Yeah.
So the transactions are as follows. We have our opening balance, which can be debit or credit. There's no book of prime entry and there's no source document. We have our credit purchases, which is because the credit sales is a debit entry. Credit purchases will be what?
Debit entry. Wait, again, mister?
Credit sales is a debit entry. Then credit purchases will be what? Credit entry.
It's a credit, yeah.
So all transactions in the sales ledger control account on the debit side, on the other hand will be on the credit side.
Okay.
That's how it works. Then payments to trade payables. You make payment to the trade payables. Now you have a debit.
Yeah.
Because payment from customers is a credit. So payment to suppliers will be a debit.
Okay.
Discount allowed is a credit. Discount received will be a debit.
Mister, can you please, I'm so confused. If you just say the trade payables, because I already know the trade receivables.
So for trade payables, we have
opening balance is debit or credit?
all credit, yes. Credit purchase. That means all the credit purchases, which are from your purchases journals, all what you bought on credit.
Credit, okay.
From your suppliers will have a credit entry.
Okay.
Because listen, your suppliers will be credited because they are giving to you, right? So individual individual trade payables have credit entry.
Yeah.
So that means your control account will have credit entry.
Okay.
Is it clear? When you make payments to your suppliers, in the supplier's account it will be a debit entry, yes or no? So it will be a debit entry here too. When you give discounts to your when your suppliers give you discount to the suppliers, it will be a debit entry. So it's going to be a debit entry here.
Okay.
Dishonored check
To supplier.
to supplier, it will be a debit entry too, but it will be in the cash book.
Okay.
Then to suppliers, yes, dishonored check will be credit entry because your check is being returned to you.
Okay.
Your supplier returns the check because the check doesn't. The bank considers the check as there's a DAR. Drawer's attention is required. We call it DAR. It will be written on the check. They won't tell you why the check has been dishonored because the bank owed what we call duty not to expose secrecy or not to tell the secret of customers or client to third party.
Okay.
So you cannot, they won't tell you, they will only write DAR, drawer's attention is required. So interest charged by suppliers. If suppliers charge you interest because of late payment, it will be a credit entry.
Okay.
Then it will be a general journal and you have a statement of account for that. For credit purchases returns, that is purchases returns.
Yeah.
You purchase and you are returning to your suppliers. So your supplier will receive it. Yes or no?
Yeah.
You debit the receiver, debit entry. It will be purchases returns journal.
Okay.
And it will be credit note. A credit note is a note stating that a certain product has been returned by the customer.
Customers purchase the returns table.
Do you get it? So as soon as the credit note is received, the supplier will issue a debit note.
Debit note, okay.
Put that in mind, please. Then we have transfer of debit balances in the trade receivable account to trade payables. That is contract. That is called set-offs.
Yeah.
There are some situations whereby the buyer will also be the seller.
The buyer may be the seller, third party.
No, it
Not
means
third party, like
I'm buying from you and at the same time I'm selling to you.
Oh, okay.
So that means we might as well use
trade.
We call it set-off.
Okay.
So that takes us to contra accounts now anyway. For contra account, it means it's going to be on both on the debit side if it's on the debit side of the sales ledger account, it will be on the credit side of purchases ledger control account. That's what we call contra. Do you understand contra there? So for contra, setups occur as a result of a business having to deal with another business as both trade receivables and payables. So the format for trade payables, we have the debit side, we have our balance breakdown, we have here. We have our bank, we have return outward on the debit side, we have set off trade receivables. Set off trade receivables on the debit side. Then on the credit side of the trade payables, we have set off contra. Then we have discount received on the debit side. Then on the credit side, we have the balance and the purchases, credit purchases. Then we have activity 1.
Mr. Did we see the balances on both sides?
Yeah, it could be on both sides, yes.
But they're like certainly trade receivables accounts and credit because they have overpaid.
I told you that already. If the normal balance for trade payables is supposed to be on the debit side. If it's on the debit side, if trade payable is on the debit side, if you at the end of the month your trade payable is on the debit side, it means you are owing suppliers.
I'll do that. Activity 1.
So we get it in activity 1 anyway. So we have activity 1 here. So they said the following information is available to allow you to prepare a trade payables control account for Nicholas. We have different items here. We have opening balance for 8,512. The opening balance here is a credit entry.
Debit or credit? Both of them.
Credit now. Credit entry. Because they said it's trade payables control account for Nicholas.
Okay. Purchase day book is credit.
Opening balance, first is opening balance.
Yeah.
8512. That's our balance carried down. Balance carried down. 8,512.
Okay.
Yeah, on the credit side. The purchases day book is also going to be on the credit side.
Credit side.
Then we have payments to trade payables. Your payment, that is bank.
Payments to trade payables, okay.
That's bank on the credit side, on the debit side.
Okay.
Listen, you are preparing a trade payables control account. Whatever will happen to individual purchases or individual suppliers account will happen to the purchases accounts too.
Okay.
As soon as you purchased, you have your credit supplier. You credit your credit supplier sold to you. So that means you credit the receiver, you credit the giver. Now, the same goes here. So all credit purchases will be credited in sales or in purchases control account.
Okay.
All credit sales will be debited in sales control account. So here we're talking about trade or purchases. So opening balance will be on the credit side, 8,512. This is purchases dayable, which means credit purchases.
Yeah.
It will be on the credit side for 7,190. Now we have payment to trade payables. Payment to trade payables will be on the debit side as bank.
Payment to trade payables, okay.
Yeah, it will be on the debit side as bank. Discount received.
The debit side, yeah?
Yeah.
Okay.
Discount received. Because it is discount received, it will be on the debit side of trade payables control account.
Debit side, yeah.
Then we have returns outward. It will also be on the debit side of trade payables control account.
Okay.
Contra. So contra here is talking about trade receivables.
So it is on the...
Listen, for this contra, it's going to be both in trade payables account and trade receivable account.
Okay.
But here it's going to be on the debit side of the trade payables account. It will be on the credit side of trade receivables control account if we are preparing one.
Okay.
Cash sales. Cash sales is not going to be here because we are talking about trade payables account.
Yeah.
Cash sales will be in the trade receivable control account. But we are told to prepare trade payables control account.
Okay.
So we don't have any issues with that. Irrecoverable debt is going to be sales. Irrecoverable debt is for the credit, is for the business. It does not have anything to do with supplier's account.
Yeah.
Do you understand what I'm saying here? Irrecoverable debt is from your sales.
So on the debit side.
It's from the sales. It doesn't have anything to do with trade payables.
So what?
These are your supplier's accounts.
Okay.
So cash sales, allowance for irrecoverable debts are not part of trade payables.
Okay.
They are trade receivables.
Yeah, they're even trade receivables. So they just leave them out because
You
they're
leave them
general,
out, yes.
general.
Dishonor check received from customer. From customer, it's not going to be part of this. It's sales.
Because it's from supplier.
This is for supplier. That means payment to suppliers will be here, not payment from suppliers.
Yeah.
So dishonor check
Received from customer.
From supplier
Will be here.
will be here. Not
Customers
December
from
check
receivable.
received from customers.
Okay.
So our transaction here will be, the items here will be 4996 plus 711 plus 657 plus 755 minus 8512 plus 7190. So the total balance from the credit side is 8,583.
Yeah.
The total on the credit side is 15,702, which is less than the debit side of our trade payables control account.
Okay.
So that means we still have to pay our trade payables 8,583. The difference between the debit side and the credit side. Is it clear? So the total here has a difference of 8,583 on the debit side. So the difference is what we are owing our trade payables.
Okay.
So that's the balance carried down, which becomes our balance brought down for July, because this transaction is from June. So it goes to July as the balance brought down. So the opening balance in July will be 8,583.
Okay.
Do you understand?
Yeah.
Any question about that?
No.
So we end the lesson here.
Only end the class.
We end the class, yes.